Singapore banks are likely to see a squeeze on earnings with a cloudy economic outlook for next year. Analysts say loans growth is expected to fall even further and credit risk may go up. Meanwhile, banks are expected to further step up efforts to stay ahead in the digital revolution. Nicole Tan has more.
From personal data theft to pilfering funds, cybercrime comes in many different guises, and banks in Singapore have cited criminality as the top concern they currently face in a recent industry survey. Amid a fast-evolving digital landscape, observers say the biggest challenges facing banks in Singapore are technology-related. The external environment, too, presents increasingly significant challenges to growing the top line. For the whole of 2015, they expect growth in the overall loan books for Singapore banks to come in at some 5%. However, they warn that this could slow down even further in 2016. Another credit risk, analysts say, is the anticipated rise in interest rates as the US Federal Reserve normalizes monetary policy. Still, higher interest rates are seen as a double-edged sword, with higher interest margins helping to support interest income.
And here to tell us more about the challenges banks will face in the coming months is Tham Kit. He's Risk Practice Director at Walters Kluwer Financial Services, Asia Pacific. Welcome, Kit.
Thank you, John.
Kit, tell us, what are the key regulatory challenges that are sort of facing banks in Singapore and the region?
Regulations concerning banks' funding liquidity, anti-money laundering and standardizing regulations across various countries are the key challenges for banks in the region. So recent MAS rules are asking banks to increase its cash buffer. Increased cash buffer means that the banks will be better at fulfilling their cash obligation. However, with the increase in cash reserve, banks will need to constantly reassess its business and channel funds to areas where it has comparative advantages. Customer, on the other hand, will enjoy services from banks who are at best at providing that services that the customer needs. Regarding anti-money laundering, MAS has been enforcing deficiency in anti-money laundering and counter-terrorism financing measures.
Right.
So, for example, last year, MAS issued 9 observations to financial institutions in Singapore, and this year, MAS has enhanced supervisions with 2 additional notices. Finally, with having mentioned all these increased regulations, we are seeing that all these regulations in different countries are different, and so it adds to operational complexity for the banks. Standardizing these operations, these regulations, will enable the banks to pass on potential cost savings to the customer through economies of scale.
So this is quite a basket of regulations that the banks will have to be adhering with. What about the consequences if they don't manage to follow these directives?
Yes, so the consequences are usually observations by MAS and potential penalties. And at the very worst case, there might be some issues with their license.
Right. What does it mean to have an observation issued?
Observations are MAS will suggest their audit observations and suggest how the banks can improve with a timeline.
Right. So, Kit, how will the new rules, for example, funding liquidity, sort of influence banks' lending decisions? Could you give us a couple of examples?
Essentially, regulations requires the banks to hold more cash buffer to withstand economic changes. So take for example, if you look at a structured product with derivatives components, today it requires more cash buffer than before, and so increase the cost of this product. Another example will be the discussion about reserving cash buffers for the undisbursed portion of housing loans, which also increase the cost of this product. So all in all, banks will need to reassess their business and find out where their strength is, exit their non-core business, and channel their resources into areas where they are comparatively better.
Let's look a little bit further ahead, Sun Kit. What sort of new banking regulations do you think we are going to be seeing in the next couple of years?
They are the revised standard to trading book capital management and counterparty credit risk. So these are initiatives led by the Banking Supervision, the Basel Committee for Banking Supervision, which helps the bank to enhance its internal risk management control by incorporating lessons learned from historical financial crises. Then secondly, we are looking at the alignment between risk and finance through the International Financial Reporting Standard IFRS 9, where the element of risk assessment is enhanced by considering potential future losses. Then thirdly is the compliance with tax. There's the FATCA and the globalized version called the GATCA. So FATCA come into play this year, and GATCA is expected to come into play 2018. So these regulations encourage transparency in sharing tax compliance information, and they will help to facilitate the growth of Singapore as a major wealth management hub. And finally, the emergence of many fintech firms today providing financial services that compete in the space of regulated banks. Because these fintech firms are largely unregulated, but they have easy accessibility to anyone with internet and not limited by geographical boundaries. This is likely to be a regulatory challenge in the coming years.
All right. Well, thanks very much for those insights,
Thank you, John.
I've been speaking with Tham from Walters Kluwer Financial Services, Asia Pacific. Let's move on to some stock market action now. Singapore shares rose today in line with gains seen in most Asian markets.